Let's talk about the first trend in terms of equity inflows. There has been a rapid rise.
Course, hi Kavita. I think the one of the biggest trend that we have seen is the investors' faith in the mutual funds category, the industry initiatives of education, mutual funds year campaigns around throughout the year, the positive experience people had towards end of 2020, 2021 in terms of returns because of whatever people took a opportunity to invest when the markets were low. And of course, general rising awareness about the category has ensured that the right ways to invest, which is basically via SIPs, actually continue to build as a stronger habit for the country. And that is visible today. Almost year to date flows via SIPs alone have been about 1.22 lakh crore rupees, and which is basically means almost 10,000 crore plus worth of money is coming on every month in the equity markets, because primarily SIP flows are equities. So it has been a great kind of faith that people have exhibited, the discipline that they're investing the money in markets, and that is also helping the markets stay afloat when the times were not very rosy in the times of Feb and March or some part of the year as well. So it's all on good in my opinion. The year is ending looking like on a nice note.
So, what is the investment takeaway for an investor and a learning for 2023 from this?
So I think the learning for the year ahead will always be the back to fundamentals, Kavita. One needs to first of all stay disciplined investing. If you give time to your investments, returns just follow. Kind of earning returns or creating wealth from mutual funds or generally investing in life is more of a function of time you give and not necessarily the asset class you hold. It's if you give time, returns follow. So what has shown people is 2021 was a great year for returns. 2022 was looking like a bad year, but it is almost ending on a positive note. I think year to date Nifty would be about 7% up. Most of the flexi cap mutual funds would have given about 5% thereabouts or slightly higher returns. So a year which was so uncertain. So many global developments, Russia-Ukraine war, which is refusing to end, oil, inflation, central bank raising interest rates, and in the end, the retail investors come across as someone who is triumphant or has won the battle of staying put and emerging as a winner. So I would say discipline is one thing. The second aspect I would put is asset allocation. So as we have seen, this year has been extremely good for multi-asset funds. That just shows that if you are somebody who is actually diversified across asset classes, you tend to make better returns because you would not know which asset class is going to perform in the future. And third piece is basically just having a plan of asset allocation for yours which suits you. So something which suits you tend to hold for longer even if the going is not good. So always buy something which is suitable to you so that you can actually show patience and discipline during the times which may not be favorable. And again, because you'll give time, compounding will follow.
A very important takeaway. Also, one thing, Santosh. Now, a lot of underperformance has been noticed from actively managed fund, which has also, had investors moving towards index funds or maybe having a passive strategy for large caps, especially in their portfolio. Is this a trend, an overall trend that we saw in 2022? Can this be called as a new emerging trend in 2023 as well?
I would say yes, Kavita. I guess what is happening is because more and more new investors are coming to the marketplace, and there's a rise of low cost investing. There's a rising awareness to also do a DIY kind of approach to investment, do it yourself, as we call it. It is giving rise to looking for simpler options. And as more aware people become, they're realizing that at least in large cap space, the actively managed funds are struggling to justify the expense ratios of an actively managed fund. 85% or more funds are underperforming over a 5-year basis, and similarly on a 3 and 7 year basis as well. So what is happening is instead of buying an actively managed fund, which may or may not become the winner, people are finding it far more easy to stay with index funds, and that is showing in the rising inflows. I think to anybody it would have been surprising in that sense that just about 2 years ago the flows were about 5,000 odd crores. In 2021 we got that to about 16,000 odd crores. This year alone has seen 64,000 odd crore money flowing into index funds. I think is a factor of two more things. What is also happening is the asset management companies or the mutual fund companies are also launching these products with a lot of regularity and innovative and differentiation to some extent. So we have seen a rise of factor funds, as we discussed a couple of times in the show as well, like momentum as a factor, or value as a factor, quality as a factor, alpha as a factor, multi-factor funds. So people are actually seeing a lot of different variants of passive investing or rule-based approach to investing than relying on a fund manager unit alpha, and that possibly people tend to believe and put their money to. And that is a very healthy trend, because what happens is, at least in rule-based investing, on factor-based investing, passive investing, you would at least know how the fund is going to get managed and what kind of holdings are going to be there forever. And your trust and faith tends to be for longer time in these products, even if the performance is not up to the mark or up to the expectations. So I would believe that the passive and the factor way of investing is here to stay, and possibly going to go stronger, as we've seen in the developed markets as well.
All right, let's talk about the favorite category that's emerged actually in terms of the top picks for investors. What kind of mutual fund category are we talking about over here?
So I think this year has been a year of flexi caps. A lot of fund houses actually were forced to launch a flexi cap fund because of the SEBI's recategorization of earlier flexi cap funds into a multi cap fund, and a new category of flexi cap fund was allowed to get launched. So some of fund houses actually renamed their existing funds. Some of the funds houses actually chose to stay as multi-cap and launched new flexi-cap fund. So actually we saw more than a few NFOs on flexi-cap as a category, and that actually helped this category to raise a lot of money from retail investors or first-time investors. And generally flexi-cap category is a better way to invest for a lot of retail investors, in my opinion, for the fact that it allows the fund manager to actually stay market cap unbiased. In that sense, it allows him to invest him or her in a very market cap agnostic way. So the fund manager would decide whether he needs to put in all the money in large cap, or have a mix of large, mid, and small cap. And it basically also is more diversified equity exposure. So what happens is, the fund manager at least has a chance to outperform because of mid cap and small cap aspects coming into the portfolio. So this category has possibly remained kind of a mutual fund favorite for a lot of investor, simply because it has given constant performance throughout a decade or so. And I think it's very legible that this category continues to see larger flows as far as active management is concerned, in my opinion.
Sure. Given the fact that the market has been volatile for a major part of this year, why hasn't hybrid category picked up?
So I think hybrid is always remains a puzzle, Kavita. That why the retail investors basically underappreciates the importance of hybrid funds into the portfolio. What we have seen on ET Money is typically a lot of bias comes in because of recent outperformance in a specific category, and typically you would not find hybrid funds ever top of the chart, simply because they are always having some amount of debt in the portfolio, be it aggressive hybrid, which is the most aggressive version of hybrid funds, typically can going up to 80% equity and minimum at least 65 in equity. So at any point of time, most hybrid funds would tend to have 25 to 30% of their portfolio into debt. And by definition, in a bull run, they would look like a bit laggard compared to a flexi cap and large cap categories. Second aspect is the understanding of this category becomes a bit complex, because there are four different versions, in my opinion, which are mainstream retail, be it equity savings fund, conservative hybrid, aggressive hybrid, and balance advantage fund. There are two more, but I'm focusing on these four right now. These four actually are quite mainstream for retail investors to understand and make it a part of portfolio. But many people don't understand the tax implications of this, which is suitable for a 3-year horizon, which is suitable for a 5-year horizon, which is suitable for a 10-year horizon. And most people, as I said, are biased towards recent returns. And because these are not top of the charts, they tend to get ignored. In my opinion, these funds should actually become a core holding for almost every kind of investor, simply because of the benefits of auto rebalancing without tax implication, the benefits of kind of having a mix of two asset classes in the portfolio, and of course multi-asset, which actually gives you asset class of three. Of course, multi-asset has been like not a kind of a considered performer given the past history, but the concept is pretty strong. And in my opinion, as we see more learning from a lot of new investors who stay invested, as the penetration of category goes deeper into the Indian population, I'm sure habit category will become one of the mainstream categories in time to come for investments.
Right. Let's talk about the SIP book that looks like growing continuously. So, have people or a normal retail investor understood markets? Their confidence has gone up when it comes to investing in market, that too through SIP.
I think it's pretty amusing to even counter questions even today, Kavita, when people actually uh, tend to feel that SIP is different and mutual funds are different. We still have kind of people who don't understand. But what is good is they've at least heard and understood that SIP is one of the best ways to invest. So maybe that generalistic statement is playing a lot on people's mind, and of course it is helping them. It's not that it is helping the industry in isolation, helping them to create wealth. They tend to kind of not track returns way too often. They tend to believe in the concept of rupee cost averaging in terms of buying at every levels and not time the market. They tend to kind of stick around to their SIPs as if there's the only way to create wealth for long term. So I think these are somewhere healthy practices that has got into the mainstream. And I think it's also about the proliferation of wealth apps like ED Money in that sense, because today investing has become far more easier because of digital KYC, paperless investing, easy ways to monitor portfolio, online making payments like paying via UPI, or setting up a mandate to auto debit your SIPs. So all these technological simplicity, innovation, proliferation of wealth tech apps, belief in the category because of anecdotal evidences in the friend circle, relatives, extended family. All these things have come together, and of course, markets have been supportive as well because the returns ultimately attract people. So all these things are coming together and possibly increasing the belief in the category. And in my opinion, I would not be surprised if we see the SIP book next year, same time, at least about 15 to 17,000 crore on a monthly basis.
Right. So these were the latest trend that we saw picking up in 2022, and I'm sure we'll have one more round of discussion, Santosh, where we'll discuss about emerging trends for 2023. But then for now, that will be all. Thank you so much for being a part of this show.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.